I'm very happy that I'm in this strategy right now because if anything, volatility seems higher than ever for all
Hmm.
kinds of reasons, some economic, some geopolitical, some more political. But for whatever reason, there are a lot of macro reasons that make me happy that in my micro investing, I'm doing it in a fairly predictable and not dependent on capital gains, so I can sleep a little better at night.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When stocks are as richly valued as they are today, investors, especially older ones looking to live off the wealth they've already built, start to prefer safer assets that provide income. Today's guest, Stephen Bavaria, author of The Income Factory, has appeared several times on this channel sharing his approach to income investing, which he claims can deliver similar long-term returns as stocks, but within a greater margin of safety. Stephen returns today to give us an update on how his approach is working here in 2025, a year of elevated volatility and bond yield so far. Stephen, thanks so much for joining us today.
Thank you, Adam. It's a pleasure to be here again.
Thanks. Well, it's a pleasure to have you back on, my friend. All right, Stephen. So, the main point of this discussion is to give folks an update as to how the Income Factory framework is performing so far in a year that's been quite volatile. Um, I guess let's get straight to that, but maybe in your answer, if you can just start off with giving as concise a summary of your Income Factory framework for the people that might not have seen your previous interviews on this channel.
Sure, and I'll try to keep it as concise as I can. I think most rational investors over the long term would like to earn what's a typical equity return of, say, 9 or 10%, over the long term. And if you do it with traditional equity, uh, Nobel Prizes have been won demonstrating that the easiest and best way to do that is to buy an index of, the S&P 500 or something equivalent, hold it through thick and thin, and generally you will achieve over that long-term average say plus or minus 9%. I don't claim the income factory is any better than that at all, but it's an alternative way to try to do the same thing. If you think that math is math, and that you earn a total return it's the dividend plus the capital gain or loss on your portfolio, and those two together added up in a period is the total return. That means you could earn a 9% return with 9% yield and 0% growth, or 9% growth and 0% yield, or anything in between, 5 and 4, whatever. And so it's a mathematical certainty that you could achieve that with yield, and not much capital gain at all. And that's the approach I take. Now, what's not a mathematical certainty is that the particular assets I choose that I think will get me my 8, 9, 10% yield will actually do it. I mean, there's always risk, that you won't earn that yield or the capital gain if you're going the other route. But the income factory is an approach that where we try to use mostly high yield stocks and a lot of credit investments that earn 9, 10% or more sometimes in interest, and those are more predictable asset classes because you're not depending so much on capital gains. So that's the theory, and that's what we're trying to achieve. I try to achieve it personally, mostly with high yield credit investments, using closed end funds as the vehicle to hold them, because closed end funds are often a better, more effective way to hold illiquid or less liquid assets, and high yield bonds, senior loans, CLOs, which we've discussed, collateralized loan obligations, and different sort of complex asset classes or less liquid are safer to hold in a closed end vehicle. So that's why I use those, sometimes ETFs as well. But so our approach is, it's about 75% credit and maybe 25% utilities and other high yielding equities in my own personal portfolio and in the model portfolios we use. And recently, just to say how we're doing, we've been earning yields in the 10 to 11% range. I'm a little more aggressive in my personal portfolio, so I'm up to about 12% yields. And in terms of total return, we've actually been matching pretty well. That's not our goal so much, but we have been matching the S&P 500 in that we've taken some capital losses, on paper losses, but they're offset by the yield we're getting. And if you don't sell, my approach is to not worry much about short-term capital gains and losses and just build up the income, reinvest it. When you reinvest, if your prices are down and you're reinvesting the same income you were earning 6 months or a year earlier when prices were up, you're actually reinvesting at lower bargain prices and higher yields. So you're building your income faster during periods when when the market is actually down. So anyway, we've been earning the same total return for the last year or so as the S&P 500, but they're only paying a yield of about 1.5% or a little lower right now, whereas we're collecting yields and reinvesting them of 9, 10, 11%. So that's where we are, and I'm very happy that I'm in this strategy right now, because if anything, volatility seems higher than ever for all kinds of reasons, some economic, some geopolitical, some more political. But for whatever reason, there are a lot of macro reasons that make me happy that in my micro investing, I'm doing it in a fairly predictable and not dependent on capital gains, so I can sleep a little better at night. And I'm told by many of my readers and members of my investment group that they're sleeping better at night too. I hope that's the case.
Okay, well, great summary. I'm glad to hear that things are performing well. Congratulations that the income factor is continuing to do well in this type of environment that we're in. I just want to underscore and dig into a couple of things you mentioned here. So first off, your goal is steady returns, right? So you're basically trying to build a portfolio that delivers S&P-like returns over time, but really without all the volatility, right? The S&P delivers those average returns, but one year it might be up 20%, the next year it might be down 8, et cetera. So on any given 12-month comparison, it fluctuates wildly, where the income factor is much more steady Eddie, right? Hey, we gave you 10% last year, we gave you maybe 9% this year, maybe 11% the year after that. It's much more steady, correct?
That's the plan. And to get even one step nerdier about this, my underlying philosophy is pretty much based on what they've been teaching in finance courses in grad schools, although I never took any, for years, going back to the 1930s, that the market prices of any asset theoretically reflect the income that it generates over its life.
Right.
And that at any given time, the discounted present value of the future income of an asset is what it's, in a perfectly efficient market, is what its market price would be. So what I'm really trying to do is manage for that income flow. And my theory is that since most of us are saving and investing for, to create our own pensions, if you will, 10, 20, 30, 40 years from now, depending on our ages, if we focus on building that cash income, then market values will pretty much take care of themselves. And if I'm growing my income at 9 or 10% a year, which means I'll be doubling the income under the rule of 72, every 8, 9, 10 years, depending on what rate I'm getting, I'm averaging, then it's going to be, who knows what, 16 or 32 times what I'm starting with, and I'm adding to it anyway over time. So the market price will take care of itself, but I'm not really worried about that, because my income itself will be so much greater years from now that, that's why I can say somewhat confidently that short-term market swings I can pretty much ignore.
Great. And I want to dig into that just a little bit more. But let me walk my way there. But I am correct where the factory basically delivers much more steady and dependable returns on
Mhm.
average than an equity index like the S&P, right?
That's exactly. It will over time, and it definitely will if what you're defining as returns is the income, the cash income that it's steadily growing, then it
Yes.
definitely will. Yes.
Sorry. Yes.
Mhm.
Those income yields. Yeah. So for example, we take 2025. Market is really pretty, it's little change since the start of the year. But if you went on that ride as an equity investor, you were panicked, in April, right?
Mhm.
Whereas if you were in the income factory, well, you didn't really see that much of a difference at all to your income streams any given month, January through June so far, correct?
That's right. It's interesting. The market value of my personal portfolio, which is modeled pretty much. I have a core model. I have other models for our readers, but I also publish for total transparency what my personal portfolio is, and the proportions I have in each fund and everything. And it's equal right now in market value to almost exactly what it was at the beginning of the year. But it's been up and down, just like an S&P 500. It's kind of matched it to some extent. But my monthly income is actually up from what it started at, which is what I make. In other words, I'm reinvesting, and that income is growing, even though the paper value of the portfolio creating the income is worth less right now. But I'm
Right,
not
because
sure
and that's what you were saying
doing.
earlier, which is periods where the market value of the actual
Yeah,
underlying instrument goes down, your dollar cost averaging in with those
that's
monthly
right.
income payments at lower and lower amounts.
And
Okay,
yeah, it's the portfolio is doing its job the way a factory that Ford Motor Company builds spends millions on, but nobody at Ford except the green eye shade accountants worry about what they could sell the factory for, a week or a month or a year later. They only focus on how much it's producing, how many
how many
cars.
cars come out? Right.
Yeah, that's why I call it the income factory. It's kind of a cute name that I
No, it's
trademark.
it, it,
Yeah.
it's a great name, and I'm working my way towards where I think you're going here, which is there's the yield that you're getting every month,
Mhm.
right?
Right.
And the annual yield of about 10 to 12% somewhere.
Yeah.
And then there's the underlying market value of the instruments. And I want to get to that in a moment because I think that's where people maybe have the greatest hitch about getting into the income factory. So I want to address that head on in just a second, but I want to clarify one or two other things closely first. Um, so you mentioned that closed-end funds are a common instrument or vehicle in which you use to invest in these income-producing assets. And I just want to note for folks, and have you correct me if this is wrong, but uh, what that allows you to do is two things. You can look at um, the instrument and say, okay, this is a good time to invest in this type of product, right? CLOs, whatever, right? So you can kind of look at the market environment for that asset class and say this is a
Yeah.
good time to add them to the portfolio given their value. And you can use a closed-end fund to do that. But then because it's a closed-end fund, um, it can trade at times above or below its net asset value. So you can just look at how that particular fund is trading relative to its net asset value, and you can say, well, I'm not going to buy it today because it seems a little bit rich, but I'll wait until it gets to a discount of its net asset value, and then I'll buy in. So you have the ability to buy an attractive asset class at the right time in that given fund, given the potential discount the fund is on, right? So there's two ways to kind of get addition, or two ways to go for yield there, correct?
That's right. Once you've decided that asset class X, corporate loans or high yield bonds or whatever it is an asset class you want to be in for all the, economic reasons and everything, then you go into the closed end fund market and you may find 10 or 20 funds that all are involved in that asset class, and you narrow it down. You want to You want to pick ones that are well managed, that have been around a long time, that have a good long-term record. But then, as you say, some of them may be selling at discounts to the asset value of the fund, which means if you took all the assets in the fund and added them up and divided by the number of shares outstanding, their actual net asset value per share would be higher than what their market value currently is, because it's an illiquid market. Closed-end funds are a kind of funky market where it's not always high volume. So one big player moves in and buys a fund, and it drives a premium up for a day or so, or a week, or a month even, or a bunch of people get scared out of an asset class for reasons I don't regard as rational, let's say, and it'll drop to a discount. So you can time your trades in and out to kind of increase the value you're getting, increase your downside risk a little. All that, yeah, you can do all that to kind of help yourself, at the margins. And you can trade back and forth. You might have two senior loan funds that are equally well managed and with good records, and you might trade back and forth over time between them. As one goes to a premium, you sell it and you buy the other at a discount, and vice versa.
Great. So I just wanted to let folks
Yep.
understand that there's kind of, there's additional ways to gain value here. And one of this is through the arbitrage of what the funds are trading at on any given day. All right. So, I really like the analogy of the factory. And as you say, if you're Ford, you don't really care about the market value of the factory because you're not planning on selling it tomorrow, right?
Mm-hmm.
You care about how many cars it's making, right? And your portfolio is very similar, where you don't really care on any given day what its market value is. If you add up all the securities that you have in it, you care much more about what's it giving me this month in terms of a return, right?
Mm-hmm.
So I think
Real
one worry
estate.
that people have, let me just
Mhm.
mention this, you can answer.
Sure.
So I think one worry that people have is okay, well, if this instrument is giving me yield over time, but the absolute underlying value of the instrument is declining over time, that makes me nervous, and maybe I'm not gonna, maybe the income payments over time won't add up to if this thing goes to zero, add up to the market value that I've lost or whatnot. So how do you talk to that concern, and how often does that happen?
Actually, that's a good point, and it's a tricky one that I've written a number of articles on Seeking Alpha for regular Seeking Alpha viewers, readers, and for my own investor group. Total return, you start with that. The total return of a fund is its dividend plus capital gains and losses. And there are funds out there, because there are a lot of income investors, retirees, other people who really love income, who buy closed-end funds. And some closed-end funds are more careful, I'll say, than others. Some will stretch to give greater income than they actually earn as funds, and sometimes funds can hardly avoid doing that either, because the way closed-end funds work, they're required by regulation to pay out, I believe it's 90% of their taxable income. And if you're a fund that owns loans, for example, or other assets that, pay off at maturity contractually at 100%. You have a loan, it pays you 10% interest, and then you collect your 100 cents on the dollar when at the end of 5 years or 10 years or whatever. There are some defaults, in the credit markets.
Mm-hmm.
It's like there are bankruptcies in the stock market. And sometimes a fund will be collecting interest from various assets, and putting that into their income because they have to. It's their taxable income, the cash they collect, and they have to pay out 90% of that as dividends to their shareholders. If some of those they don't end up collecting 100%, and later
Right.
in the life they only, they go bankrupt or they default, and they only get back 60 or 70%, which is normal with a loan. You're secured, you get back 70%, but you take a loss of 30. You've already paid out your dividend, assuming you're going to get 100 on that.
Mm-hmm.
So there's a certain amount of natural declining annuity in certain asset classes. And some funds are better than others or better able to kind of reserve for that. See, they're not, if it were a bank like JP Morgan, they could reserve and take it off their taxes for potential loan losses. But closed-end funds pretty much have to pay out what they collect, and they can't reserve for potential losses that way. So yes, you have some funds that pay out more. And what happens is this erodes their price, their net asset value, or even their market price. If the market sees this happening, it'll bring the market price down, and the net asset value will be going down. So you might have a fund that is paying you 12%, but then when you look at its total return over time, it's only 9 or 10%. That means that its dividends are high, but it has a capital loss. So its total return is the difference between the two. So you could have a 14% dividend. The fund might erode 3% a year on its price. And so its real total return is only 11%. It's still a good asset. It still can be a good investment because 11% is a pretty attractive return. But
Right.
if collecting 14%, you've got to be alert to the fact that, hey, I'm collecting more than this fund's actually earning. So you better at least, even if say you're retired and you're collecting your income and spending it, you don't want to collect more than, well, in that case, 11%. If you took out the full 14% of the dividend and the price of this fund was eroding by the 3% difference, and you kept the whole 14%, pretty soon you'd have a dwindling annuity, and you don't want that. But if you reinvest at least the 3 or 4, or even more than the difference between the distribution and the actual total return after the price erosion, then you'll be fine. I mean, I've got articles explaining that. Some people say, I won't touch any fund that pays out more than it actually earns. But if they avoid some of those funds, even after taking the difference, you're still got 11, 12, 13% total returns, and they're good investments.
Okay, and this is what I just want to make really clear for listeners. I'll make sure I'm understanding this right. So, should we think of the income factory as I put capital in, that capital is going to the market value of that capital is I should expect it to erode at some rate, but I'm looking to try to get a return, a yield off of that capital, or income off of that capital, that is going to grow hopefully substantially higher than the net asset value erosion. And so to use your example, maybe the company is paying out 13%, but when I take into account the erosion of the actual asset value, given the income I've gotten offsetting that, I'm getting about a 10% or 11% return, right? Still a really good return, still a great investment. It's a reason to do this, but I've just got to be aware that what I'm really looking for is income to dramatically offset the capital erosion. And if I heard you correctly, if I were to completely if I were looking to live off the income of this thing, right, and it's paying me X income and I'm spending all of that, well, then you have this eroding annuity that's not going to be around forever. So two things you want to consider. One is obviously if you don't need to live off it, at least not yet, just keep reinvesting the income that you're getting, and that will dramatically grow your net asset value over time because yes, it's eroding at a certain rate, but you're reinvesting much more income than that regularly to buy more assets. And so net your assets are growing. So to your earlier point, as time goes on, your thing is kicking off more and more absolute income because it's continuing to grow. Now, if you need some income, what you want to do is you want to make sure that you're at least you're at least keeping enough income or reinvesting enough income to make up for that erosion of net asset value. So over time, you can kind of at least keep your net asset value steady while you're living off of some income. So there's lots of ways to play this. You can just reinvest everything and grow to your heart's content. You can operate it at sort of steady state, have some income, keep your net asset flat. Or maybe if you're 90 You know, you just start living off the income and you don't really care because you're going to outlive the erosion of the underlying capital. Did I capture that correctly?
You did, but I would like to emphasize, I mean, that my intention is not to is not to have my capital or any of my members of my income factory, my inside the income factory group, let their capital diminish unless they chose to. You're right. Even most retirees, though, if you retire at 60 or 65, as many people do, or 70 even, a lot of people live into their 90s these days, and certainly we all hope to. And so you've got to be investing with a bit of a long-term flavor, even when you're retired. But as you say, once you're maybe 90, and if your kids are all doing well and you aren't worried about leaving a lot for them, yeah, then you could actually turn your capital into a bit of an annuity and really go out with a bang your final years. But just to look at my core model, my main model, for example, the last time I reviewed it about a week ago, the average yield, this is about almost 40 different funds, and people can pick and choose which ones they want. Not everybody buys the whole model, but its average yield is 11.2%. Now, if you go back over 5 years, the average total return is 15%. So the typical fund in it has had a total return greater than the current yield. Now, there are some years where there's a little bit of a gap because a lot of funds try to manage their yields and keep on paying. Even if they have a few months where they're not fully earning it, they're looking ahead and thinking, well, we will be earning it again in 6 months, so they keep their dividend flat. You have to keep an eye on that, and that's part of my job to do that. But my goal is not to pick funds that have this erosion, but there are some that will. And we also have some very high yielding funds that buy collateralized loan obligations, which are a pretty complex investment, but their institutions invested in them for years quite successfully. And now there's some closed-end funds like ECC and OXLC and Carlyle Credit, CCIF. But there are these CLO funds that buy the equity of these. And for whatever reasons, and some of the reasons I mentioned earlier, that they're forced to pay out. If they have very high payments in certain years, they're forced to pay out big dividends that they don't expect to actually earn over the long run. Some of these funds have been paying out close to 20% in yields. I wouldn't want anybody to buy those funds and keep the entire 20%. But if they wanted to keep half of it, they'd probably be fine and reinvest the other half. So there will be funds we pick that we know are going to have NAV erosion, but they're still going to have such high dividends that the total return will be quite adequate. But they'll be in the minority, and they're special situations.
Okay.
Like
I
those
just really
fellow.
wanted to dig into this one because I know people get hung up
Yeah.
on the like, yeah, I'm buying this asset that might go down and why would I want to do that? And obviously it makes a lot of sense to do that if the income stream is much higher than the net asset value erosion rate.
And
Um,
it's total return. The key is you got to look at total return, which captures both that erosion and the dividend. And if the total return is adequate, then it's a good investment, but you may not want to keep it all. You may want to make sure you're reinvesting a big portion of it.
well, that's the second point, and it differentiates your approach from, say, owning a treasury, right? Because
Yeah,
I can get the income from the treasury, I can spend 100% of that, and I know I'm going to get 100% of my principal back when the loan
that's true.
matures. So this one,
Yeah.
you have to, even though it's an income factory, you do want to make sure that you are reinvesting at least enough of the income that you're receiving to keep things
Mhm.
sustainable.
The lower the yield on your asset, usually the safer the principal is, and usually the the lack of any erosion risk you have. So if you're willing to buy assets that only earn 4 or 5, 6, even 7%, then there are plenty of assets that are going to not erode in principal. It's when you get up into the teens and higher that you have this potential trade-off, but it's worth investigating because to get yields that high, knowing you're going to keep most or all of it, it's worth it, if you pick the right ones. And that's our job then, to try to execute this strategy with appropriate funds, with assets that are solid, that we can depend on the income.
Yeah, and again, what's really attractive about your approach is it's self-reinforcing. The more that you allow to get reinvested, the bigger the pile that your average yield
That's
is
right.
getting applied to every year. So let's just say your lifetime, performance is 10% a year. That 10% is growing every year because the pile that 10% is being applied to is growing because of the reinvestments.
Yeah, if you start out with and you're earning 10% a year, even if you add nothing except the reinvestment, which is at 10%, you're going to double and redouble every 7 years, basically.
Right. Right. So if you're 50 and you start an income
Oh,
factory, by the time you're 70, you're going to be pretty darn happy. And this is,
oh my
again, one
God.
way to,
Yeah,
to fight inflation, right? Yeah.
even in 20 years, it's every 7 years, it would go from 2 to 4 to 8, and then to 16. In 28 years, it'd be 16 times.
Yeah. So, a guy like me who's in his, I was going to say early, but getting close to mid 50s, start this now. By the time I'm 80, I'm going to be really glad I did.
You're a kid, Adam.
You're very kind. All right. Well, look, what as you look at all the different assets that you consider for the income factory, and it might be helpful just to give folks a quick run through of a list of the different type of assets you have, because I've even forgotten a lot of them.
Sure.
There's the CLOs you talked about. There's high yield debt. There's business development corporation. There's all sorts of things. You know the list better than I. But what's performing best right now in this market environment?
Well, when you say performing, for me, performance means I'm collecting the money and I'm not too worried about default rates. Before performing doesn't mean it's shooting up in market price necessarily, but
Yeah.
I
Maybe a
feel,
better way to ask the question is if
yeah,
somebody were considering building an income factor right now, given the current market dynamics, are there any assets you would say,
yeah,
given their valuations right now, you'd say I'd look at adding these first?
yeah. First of all, since we don't know which way interest rates are going to go,
Right.
I mean, if we end up having a hard landing or whatever kind of landing we're going to have, or a recession, or if tariffs end up restricting economic activity of various kinds and we end up with a recession, rates could end up, what would they'd have to take rates down. But if we have inflation, et cetera, rates could go up. So I'd first of all say I'd want a mixture of funds, some of which are floating rate, like senior loans. Corporate senior loans have a great record, and there are some. I look at, some I like Nuveen floating rate, JFR, FS Credit Opportunity, FSCO, that are earning, they're paying yields now of 11%, some of them, that but as rates come down, these are floating rate loans. You don't have any duration risk, but your rates can come down, and it's normal that they will. But I hold a lot of senior loan funds, but then I also own high yield bond funds, some of the PIMCO funds, the like KIO, that's KKR, Income Opportunities Fund. I like funds that are run by people that have been doing this a long
Yeah.
time too, really good credit shops. Because I'm not worried if rates go up or down, and the income they pay, the rate they pay changes over time. I'm quite prepared to have part of my portfolio earn 8 or 9%, and other times earn 10, 11, 12%. But I want people that really have been doing this a long time, like, go ahead.
Yeah. Let me just add on to that, Stephen.
Yeah.
So, folks, if you're new to this concept, right, and you think, oh, income factory sounds really cool, I might want to do that myself. First off, go buy Stephen's book, The Income Factory, and you can see it right there. You can get that on Amazon and
Shameless,
everywhere.
shameless self-promotion, we call this. Yes.
Yeah. But folks, you can buy that anywhere that books are sold. So develop an understanding of kind of the mechanics of it. But, like anything, it takes a while to become a master at it. And so I would highly recommend looking over the shoulder of someone who's very seasoned in doing this. And so therefore, at the end of this, Stephen, let you tell everybody where they can go follow you and your work over there at Seeking Alpha. But obviously consider, subscribing to a service like Stephen's to watch an expert do this, and then, over time begin to copy them and develop your confidence in doing this. But then, as Stephen is saying, when you're actually deciding what to invest in, a big thing that Stephen does is to say, hey, I'm not just going to try to analyze all these individual loans myself. I'd much rather buy a fund where somebody who is an expert and has been doing this for decades and has all sorts of advantages that I don't have, relationships, economies of scale, decades of experience, whatever, can manage this for me. And that's why you like these funds, because you target funds that are run by these
Mhm.
experts with a proven track record, correct?
That's right. And I'll name like I said, I like senior loans for a lot of reasons. I like high yield bonds, which are the same cohort of companies, high yield companies. These are non-investment grade companies. They were often called junk bonds, but we know from experience these so-called junk bonds, they only default. Lately default rates have been like 1-2%. Even in a recession, they might go up to 5 or 6%. During the worst recession of our lifetimes, 18 years ago or so, they went up to about 10%. But you get back 50, 60 cents on the dollar. Typically on the loans, you get more. On bonds, you might get 40, 50%. So a 10% default rate is still only 5% losses or 4% losses, which in a recession that's not even going to take away a year's income. So it'll reduce your income that year, but it won't even touch your principal. So you're going to be so much better off, say even in a recession, than if you owned a stock portfolio. So this is very relatively predictable compared to equity. So I like I own some senior loan funds, high yield bond funds like KIO, there are a bunch of PIMCO funds, PDI, uh, there PAXS, and then like Barings, which is the Mass Mutual, which has been doing private credit of this sort for generations. I really like. They have a fund, BGH, Barings Global Short Duration High Yield. So there are a lot of funds, and then there are a few funds like Ares. There's some of these outfits like Ares, which is a great credit shop. It has the Dynamic Credit Allocation Fund, ARDC, which goes both ways. They have a mandate to buy loans or bonds. So I like people like that who can be, looking at the different markets and who know more than I do about which way interest rates are going to go and how to play it.
All right. And by the way, thank you for being so generous and naming these tickers. People love to have companies to go out and research. So thank you for doing that. Stephen is he's the drug dealer. He's given out some of the supply for free here. So if you like what you see, then go over obviously and check out his Seeking Alpha site.
You get no warranties here either. You get what you pay for. But
Yeah.
these are the things I own. And then you mentioned earlier business development companies, BDCs. They're like mini banks. And that's another asset class uh, that I buy because they do a lot of what's called private credit. It's generally secured. It's often to companies that aren't really well known. Many of these outfits, like Bain Capital Specialty Finance, BCSF, or Barings, Mass Mutual also has a BDC called BBDC, Barings BDC. Apollo has one called Midcap Financial, MFIC, and KKR has one, FSK. So you've got a lot of big names that are doing these business development companies that are essentially doing private capital, private lending, often to smaller companies that they meet because they know the private equity market really well. So you've got PE firms that do private equity that then work with sometimes it's the same firm or a part of the same firm or other firms they know well, like the ones I just mentioned, that they're lending to companies where they know the owners really well. And so if there's ever any kind of a problem and you need to work out the deal, they're working closely with the PE firm that owns it. So I'm a big believer in BDCs as an all-weather sort of asset class. I don't go in and out of loans or in and out of high yield bonds. I may switch from one fund to another depending on discounts and premiums, but to me, these are all weather funds, that all weather asset classes that you'd want to be in, all the time, and you'd be making more from in some periods than in others. So you got BDCs, high yield bonds, senior loans, and then there are like real estate funds. There are utility funds like Reeves Utility Income. A lot of people own. It's been around for years. UTG, and it was down a few years ago when the utilities all got hit, and now it's bounced back with a lot of other utility funds. So and there are infrastructure funds too that do master limited partnerships, that carry oil and gas underground all through our country, between here and Canada and other places. You have funds like Neuberger Berman has an energy fund, NML, that's pretty good. Cohen and Steers Infrastructure, UTF, is another good one. There's a lot of funds that just generate income from these different asset classes.
All right. Again, thank you for being so generous. And again,
Sure.
folks, none of this is personal financial advice. You got to do your own homework
No.
here. I would highly recommend talking to your own, personal financial
Yeah.
advisor about this. All right. So one point, and then I want to get back the question for you about the private credit funds. But in general, and you mentioned high yield bonds specifically earlier, for people who are not that experienced in investing in bonds that aren't super safe, like treasuries, right? They
Mhm.
get worried about the credit risk, right? And they
Yep.
hear things like high yield bonds, and they know they're called junk bonds, right? And they understandably may feel like, well, gosh, this is kind of high risk, and if we get into a recession or whatnot, maybe this bond might default, right? So you've done a very good job in our previous conversations talking about how one of the things that really appeals to you about the income factory is it is largely credit based. So credit is a contract, right? And it basically says, I, the business, will pay you X over this period of time, right? And so your risk as the investor in that is the existential risk of the company, right? Or the enterprise risk, I think you call it, which is, the company could go out of business, right?
Yep.
But that's the only risk that you bear, besides inflation risk, which
Yeah.
everybody bears. If you were to buy the equity of that same company, you would also have the existential or enterprise risk, right? Company goes bankrupt, your stock's not going to be worth anything. But then you have all sorts of other risk there, right? You have, well, did the company have a bad quarter and the street soured on its earnings outlook for the company, and all of a sudden the market value of the company gets cut in half? Does the general stock market go through a bear market, and that's going to bring prices down, right? There are all these things that can, all these other risks that can impact the price of your asset that you don't have in the credit world. So first and foremost, you're kind of de-risking by just looking at credit alone. Also, if there is a really negative event for the company, and let's say it does go bankrupt, well, the equity holders, they're last in line. Chances are they're going to get nothing. Depending upon where you are in the credit stack, you might get a fair amount of your money back, right? And you've even said that, even in recessions, even these quote unquote high yield junk bonds, their default risk really isn't that large. I don't want to say it's immaterial, but you've generally said it's not that material here. And the last point I'll make, and I'll let you chime in, is, you say people will look at high yield credit for a company and say, I'm just not comfortable with that. But then they'll go buy the stock of that same company. Like a lot of the popularly traded stocks today are high yield debt issuers. And so for some reason, because most people are more comfortable, familiar, whatever, with stock markets, or they'll buy into a fund that then invests in the equity of these companies that issue the high yield debt. They actually will turn down the safer option for the riskier often, maybe totally unintentionally, but it's just what their behavior is. So my overall point here is that your approach tends to be a much more risk managed one versus the equity approach, correct?
Yeah, I mean, you said it all perfectly. I summarize it in two ways. Yeah, one, that's right. Understanding that the credit risk you are taking, as you say, it's the existential risk, and the stock risk is the entrepreneurial risk. The risk when you're buying a stock, you're betting that obviously the company will remain alive and pay its debts, which is the same risk you're taking as a credit investor. But if you buy the stock, you're also betting that in addition to staying alive, it'll thrive and grow its earnings, its dividends, all of which it may not do. But you've got a CEO of that company and a senior management team who are paid a lot of money to keep that company alive and muddle through no matter what. So no matter what happens to our country, to our economy, even if the stock market tanks, you, you've got most of corporate America where there's going to be a management team working like mad to keep it alive and pay its debts because they've got so much invested in it themselves that they're and in their salaries and bonuses and everything else. So they've got to keep their company going. So yeah, I call it betting on horses to, if you could go to the track and just bet on horses to make it around the track and survive the race, as opposed to betting on the horses to win or place or show, it'd be a real easy bet to just bet on the field to get around. And that's what you're doing when you're betting on credit. But the other thing you said is true. The same people who say, oh my gosh, this junk bonds and all this, it's so scary. I'll never buy that. You look in their portfolios and they own mid cap funds and small cap funds that are filled with these same companies whose debt they say they wouldn't buy, but they own the stock. As you say, if the company goes bust, you know, they lose, obviously they lose the stock, but if the stock goes to hell, people above them buying the debt will be fine. So yeah, that's a big point in the favor of credit investing generally.
Right, right. Well, I love that analogy of the racetrack, and I think it's super apt for how for your strategy. Listening to you, it really hit me that like a lot of people will say, look, you want to be invested in the stock market long term because you are putting basically the greed of corporate America, you're having that work in your favor, right? These people want to make money. They want to get their stock options higher and all that stuff. So you're hitching your wagon to their greed, right? What I think you've done is you've gone a step below in Maslow's hierarchy of needs. Like at the core foundation, you're putting their sense of self-preservation. You're hitching your wagon to their sense of self-preservation. At some point in time, when things get bad enough, you're going to ditch your greed part and just do everything you can just to keep the company alive, right? Because you still want to have a job, you still want to have a potential future. So
That's
you've got their like
right.
the,
And
the
I've
lowest part of their base stem and their cerebral cortex is
oh,
working 24/7 for your interests.
absolutely. I wrote an earlier book called Too Greedy for Adam Smith about my experiences in corporate America, where I was very close to the compensation function at a major bank many, many years ago. And I saw how CEOs sit on each other's boards and set each other's pay, which is why you have Jamie Dimon, for example. I don't know who he does a great job, I'm sure, as CEO, and all these other CEOs, but they're making 30, 40, 50 million dollars with bonuses and stock options and even more than that, some of them, where if you went and actually advertised to hire CEOs of corporations, you'd have a line around the block of most of them of really
Hmm.
qualified people who'd be willing to do it for only maybe 2 or 3 million a year.
Hmm.
So what you say is true. Even the guys and women who make 30 and 40 million in a good year for their companies, if their companies had a really bad year and they didn't get any bonuses or anything that year, they'd still be, as you say, working like mad to keep the company alive, just to keep their $5 or $10 million base pay. If that's all they were going to get that one year or something, they'd still be busting their whats to keep their companies alive. That's what I'm betting on. That in a really bad economy and everything, they'll still be working hard for me as a creditor, even if the shareholders are, not too happy.
Yeah, I think that's just brilliant. All right. Well, look, as we start to wrap up here, you mentioned private credit funds earlier. I know that you relatively recently wrote an article about this, Stephen, and there's some sort of seasonal opportunity that you found there, correct?
Yeah, yes, I did. It's actually for two particular funds, and they're actually terrific funds. As I mentioned earlier, Mass Mutual Life Insurance they've been in what used to be called the private placement market. When I was a journalist 35 years ago, I wrote about the private placement market and met some of the people up there. The private placement market, which is where insurance companies and pension funds would buy private debt that never went through a bank or anything. That's now morphed into a larger market called the private credit market, which a lot more investors are learning about and people are getting involved in. And they have two funds that they've had around for years. Uh, One it was called originally Mass Mutual. Now it's Barings because they use the trade name Barings that they bought some years ago. But it's MPV, which is Barings Participation Investors, and MCI, which is Barings Corporate Investors. But they're twins. They're siblings that buy the same stuff, the same boards and everything on them. And they have a funny dividend policy, I think because they've been around so long. They've gotten into the habit of waiting until they have their annual meeting in May before they distribute their first quarter so-called dividend, which then gets paid out like the beginning of June. So they end up paying four quarterly dividends, both companies the same, from the beginning of June through the beginning of January. So, and actually the ex-dividend dates for those four quarterly dividends are like the end of May, and then for the first one, and then the end of December for the next one. So if you own the stock from the end of each fund, from the end of May, and then sell it the first week of January, if you own the funds for 7 months, basically, you get all the entire year's dividends because the four quarterly dividends are fit into this 7 month period. I mean, there's nothing wrong or about this or unethical or immoral. I mean, the company's a wonderful company, but they just got into the habit of paying their dividends that way. And so you could actually sell the company, in the first week of January and then buy it again at the very end of May, just before their ex-dividend date, and buy another company. Another fund that pays monthly dividends and collect 4 or 5 January, February, March, April, May. You can collect 5 months of dividends if you pick the right one. And in fact, you could pick another Mass Mutual company, a fund called that's BGH that I mentioned earlier. Great fund. It pays monthly dividends, and their ex-dividend dates are such that you can actually fit them into the January through May period that you had sold the others. So you can actually take the 8% per annum return yield on MPV or MCI and only own the fund for 7 months, and then buy BGH or any other funds that are monthly payers and collect. When it comes down to it, you're getting 17/12 of annual dividends within a year by doing this, what I call this dividend holiday trade. Now, for all I know, maybe the company will will figure this out and say, hey, maybe we should pay every month and not on this weird quarterly basis. But as long as they're doing it right now, this, it makes sense. I wrote an article about it. some of my members chimed in, and we figured out what we could do here. And as of now, you could actually get 17/12 of an annual, dividend by buying this fund, owning it for 7 months, and then buying a replacement fund in between. So that's a
That's
little benefit here by being, once in a while we get cute and figure something like this out. So
That's very cool. Well, who
there
wouldn't
you go.
love 17 months worth of performance in only 12 months? And it's great that your community kind of helped you sort of sleuth out the final approach that
Yeah,
you use there.
yeah.
So,
Now I
folks,
will mention, I mean, there's a risk to something like this because something could, the fund could become a lot more expensive. I mean, it hasn't in the past. There hasn't been any kind of arbitrage to correct this advantage. But if the fund were to jump in value over those 5 months and you went to buy it back and it was going to cost you that much more, it would obviate the advantage you had. But then whatever you bought, you could just decide to keep it because there are plenty of, you might have bought a replacement fund for those 5 months, and if you're happy with it, you just keep it and you don't buy back into these. So I don't see much of a downside risk to this at the moment.
all right. Well, folks, if you think this is interesting, Stephen has been kind enough to share that article with Thoughtful Money's premium Substack subscribers as part of this week's Macro Pass service. So if you're a premium subscriber, you should hopefully already have that in your inbox by the time this video comes out. And Stephen, thanks you so much again for making that available. But that's super interesting. All right, last question for you before we wrap things up, Stephen. Before we hopped on the camera, you mentioned something else about dynamic credit funds and why those are good or worth considering during periods where interest rates are uncertain the way that they are right now. So what do you want to tell us about those funds?
Well, the main one I mentioned was Ares Dynamic Credit Allocation Fund. Yeah, let's see, KKR also has a fund, KIO, which I think also has the flexibility if its managers choose to go back and forth between senior loans, which are floating rate, and high yield bonds, which are fixed rate. Of the two, well, they're both good funds. Ares has a better longer term performance record, I think, but it doesn't pay as high a yield. KIO pays a 12% yield right now. So they're both worth looking at. I think the PIMCO funds too. PIMCO has a great reputation for, following the markets and figuring out, how to make money in all markets as well. But Ares in particular, because it has dynamic credit right in its name,
Hmm.
seems to be promoting itself as flexible in this area. I'm just saying because yields can go in both directions, and especially right now, we don't know what's going to be happening over the next 6 months or 12 months. So having both kinds of funds, senior loan funds, high yield bond funds, BDCs, which own a lot of floating rate, well secured debt, but are managed by very sophisticated folks. Um, they're all worth having right now, just to diversify yourself so don't have all your eggs in either a rising interest rate or a falling interest rate basket.
All right. Well, Stephen, wonderful again. Thank you for sharing all of these tickers with this audience to go out and research on their own. Um, for folks that have really enjoyed this hour discussion and maybe especially some of the ones that might not have known about the Income Factory beforehand, if they would like to learn more about it, follow you and your work, where should they go between now and your next appearance on this channel?
I don't have the link right in front of me. But it's real easy. First of all, if they Google the Income Factory or my name, Stephen Bavaria, they will get links to my Seeking Alpha uh, uh, homepage, which will tell them all about inside the Income Factory and what I do. They can also go to Seeking Alpha, to the general Seeking Alpha page, which is so easy to find. If you just go on search for Seeking Alpha, you'll find it. And then within that, you could put my name or Income Factory, and you'd get brought to my site. It's easy to find if you Google me or the name Income Factory.
All right, and you know what, Stephen, too, folks, I'll put up a redirect at Thoughtful Money. So if you just want to go to thoughtfulmoney.com/income factory, it'll take you straight to that link there on Seeking Alpha that Stephen just mentioned.
Great.
All right. Well, Stephen, look, it's always so wonderful doing this. Folks, if you've appreciated this, would like Stephen to come back again in a quarter to give us an update on this framework and share what assets he thinks look good at that point in time, please encourage him to do that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you are thinking of taking up this approach in your life, like I said, definitely go to Stephen's work, learn all about it. But I highly recommend that most people just don't go, forth and start grabbing assets willy-nilly. I'd highly recommend that you talk to a good financial advisor to determine how much of your portfolio should be in an income factory strategy like this, and maybe get their help in assembling it together. If you've got a good one who can do that for you, great. But if you don't, feel free to consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. The firms will be in touch with you right away. Just a free service they offer. There's no commitment to work with these firms. They just want to be helpful. All right, Stephen. Again, thanks so much. I will give you the last word here as folks look ahead to what is likely to continue to be a volatile and mercurial 2025, filled with all sorts of surprises and news bombs like we seem to be getting multiple times a day. What would your parting counsel to today's regular investor be?
Well, I would just say good luck, first of all, but also spend time, any ideas you've gotten from me or anyone else, just make sure you think them through, do the research and understand it yourself. In other words, if it makes sense to you, then by all means do it. It's very hard. We all have to work. We worry a lot about what's going on in the world generally. I call, worrying about the macro, but we have to live in the micro. And combine the two. So best of luck, and with doing that in your own investment world. But I appreciate you considering what I do, and appreciate Adam having me on again. Thanks.
Well, you're very welcome, Stephen. And I very much appreciate that your approach is one that is very risk managed. It gives people who are nervous, especially in the equity markets today, another alternative to consider that can perhaps give them similar types of returns that the market has enjoyed, historically, but do so with less risk and allow them to sleep more at night. So for folks that find this interesting, I hope they find their way to your work. But anyway, Stephen, thank you so much, my friend. Look forward to having you back on in another quarter or so. And best of luck in the interim.
Thank you, Adam. Same to you.
Thank you. And everybody else, thanks so much for watching.